Let's go ahead and get started here. So everybody, welcome this evening to the StratiVentures public Zoom session. Today is the 22nd of June. It's 6:35, and we have Leigh McGaughy of Metropolitan Commercial Finance with us. I've known Leigh, I think we're going almost 15 years or so. I knew you from the mortgage industry and also on the commercial end. And with you, I believe, your company Metropolitan's been established since 2005, and you're also a certified commercial investment member, which is probably the highest accreditation you can get towards investment knowledge when it comes to the commercial realm. And most of all, I think, Leigh, what really I believe is a big impactor in what you do, and from knowledge of clients that you've worked with, is that you're open to work with anybody, and you like to talk to the smaller person who's growing their business all the way up to the higher end that says just get it done, right? and I think from me knowing you and how you work, you prefer the smaller business to help that business grow into a larger business relationship with you. So I want to welcome you, and I want to welcome everybody that's joining us. Leigh McGaughy. So go ahead and take it from here, sir, and everybody else that is new to this session here. My name is Diego Mello with StratiVentures, and closer towards the end, we're going to talk a little bit more about StratiVentures, but this is a general public forum that we have for it's a great time for you guys to ask questions later in the session. But we'll go ahead and give the floor over to Leigh. Welcome, sir, and let's get started.
Hello, everybody. Yes, Diego said that I'm a CCIM. I'm proud of that. That was a few years of hard work to get that designation, and it is kind of the pinnacle for somebody that's a professional in the commercial real estate field. And anybody that's in the audience that is thinking in terms of having a career in commercial real estate, go get the CCIM. It'll just enrich you as far as knowledge, being able to do Excel and the calculations for complex real estate deals. And not, of course, if you can do the complex, you can do the easy too, right? So it's just a fantastic organization, and somebody that's actually looking for a commercial real estate career, it's a strong career move too. Let's see, Diego. We wanted to talk about I'm going to hit some bullet points on a few different areas: commercial lending definitions, various types of lenders, bank, non-bank, basic documentation requirements for the borrower and the property, the loan process itself, all those things, and I'm sure you'll have questions. I'll be happy to take all of that. As far as getting started, we'll just go with some definitions. Everybody's heard of a loan to value, but then there's a loan to cost. If you're going to purchase a project that has to have some rehab or construction, you're just going to buy land and construct on it. That's when you add in the project costs to the real estate costs, then what the lender is calculating on is an LTC, a loan to cost, as opposed to loan to value. If there are no additional costs besides the real estate, then the loan to cost and the loan to value are the same, right? There's a net operating income is very important if you're purchasing a cash flowing property. If it's got leases for retail or multifamily, the property's income has to be able to cover its debt. So then an NOI, or net operating income, is going to be used to calculate a debt service coverage ratio. So I can break that down for you in that a debt service coverage ratio is your annual debt service, your NOI divided by your annual debt service. So if you have a net operating income for a retail strip center of $1 million a year, and you have an annual debt service, which is your monthly payments times 12 to the bank for that piece of real estate. If you buy, they determine what your payments are going to be beforehand, right? And then calculate your debt service coverage ratio by dividing. And so let's say that annual debt service is 800,000. So now we have our NOI of $1 million divided by our debt service coverage of 800,000, or our annual debt service of 800,000. That's going to give you a 1.25 debt service coverage ratio, which means that your net operating income is covering your annual debt service by a factor of 1.25, and that's acceptable. 1.2 is as low as most banks will go. SBA will go 1.15 in most cases. So anything above a 1.2 debt service coverage ratio is good, and you've got to go in knowing that, or it might not even be a good deal for yourself, right?
And obviously, Leigh, that's something when you're looking at somebody proposing to get into this, they do understand that all of the factors that are part of that income will be considered into the what you're dividing that into the debt service coverage ratio. So
yes, and so then you've got your your gross income minus your expenses will get you a net income, right? So you're calculating on that net income.
Hold on one second there, Leigh. Let's see. Derek asked, we're jumping straight into concept. It would be worth having some context first. Why are we talking about commercial financing? Most of our in this space, commercial versus retail, et cetera. I think, Derek, one of the important things that we want to first understand is not everybody has I would say the language or understanding the language and definitions of the concept of commercial, in which obviously we'd want to go ahead and learn that part first before we move into that realm. But I do appreciate your comments, sir. Go ahead, Leigh.
Yeah, I can kind of address that too with a little bit of an intro, maybe that I
right.
should have done, in that I'm a commercial loan broker and commercial loan consultant. That I'm independent, so when somebody comes to me, my job for them is to help them find a loan and help them through the process, and be able to help them place that loan with a lender that's interested in that particular type of project. A bank is not a bank is not a bank. It's one bank can have an affinity for multifamily and hate hotels. And you can talk to another bank that they're looking for a hotel business and they don't want any multifamily. It can be just experience of the loan committee team, whatever their commercial background is as commercial bankers and commercial real estate lenders. They've got strong points and weak points, or they've just come to a decision for their particular institution that they have certain things they want to focus on. So my relationships, my experience with these bank lenders allows me to save somebody a lot of time. And for instance, if you get a real estate contract on a commercial property you're trying to purchase, and you get too short of a time frame on that contract, you got an antsy seller, or you think you can get it financed in 60 days, and if it takes you 90 days, then you've got to go back and ask that seller for an extension, and maybe that seller doesn't want to give you an extension, and you lose the deal. Where I can help on that end of it is that if a bank goes down the road, gets you an approval or a conditional approval, but then when you get all the way through, the third party reports come back in and they go for final approval, let's say that they don't give you the final approval, you've got to shift gears. So either you've got to know where you're going to take that loan and virtually start over again, or you're going to lose that deal with the seller. So that's where my services come in, on being able to do that dance and manipulate that minefield.
Right. And Leigh, one thing to touch on Derek's point is obviously knowing that a lot of us that are here are coming from the single family residential platform and moving into the multifamily. I know that you have helped people that started with a one single family and then moved them into a larger blanket type loan. And obviously that I believe would be the main topic though, of discussion. But if you want to still continue with what are the things they look at and understanding that.
It's true. I've worked with numerous investors over the years that they started out as having a job, buying a rent home, and then that rent home turns into 2, turns into 3, turns into a portfolio. And they would get hard money here and a bank loan here, and suddenly they had all these different sources of debt, some expensive debt on properties, and I would help them consolidate a real estate portfolio into one loan, get them a blanket loan, and then I'm transitioning them. That's where I'm educating them on how to become an investor. I was joking with a client recently. I said, one day you woke up and found out you were a real estate investor. Mm-hmm. And because he had 5 properties that are valued over $1 million, all of them residential, a 4-plex, a duplex, and some single families. And I'm working on getting him an $800,000 refinance right now. And he has never been asked to do a commercial rent roll, And so if you're going to make that transition, you want to sell some houses and buy a small 10-unit apartment project, and now you're having to deal with a commercial banker. Well, you don't want to go in there not knowing what a personal financial statement is, because nobody's ever asked you to do one before. Or if they tell you they want a rent roll, you don't want to give them just a little thrown together Excel spreadsheet. You want to be able to do a real rent roll with some real commercial metrics on it. To know what a debt schedule is and a schedule of real estate owned and those things, those are the things that I bring for my clients as well.
And obviously the understanding of the terminology and having that terminology allows you to, in most cases, depending on who you're going to talk to bank-wise, even to get a seat at the table, right? because that's a big challenge there sometimes.
And with my small investors, there's a lot of little banks that don't even want to do a $250,000 loan. And then there's bankers inside a bank that one guy is, he's rolling and he doesn't want to touch anything under $1 million. And then there's a younger, hungry guy, and he'll take that $200,000 deal. He's trying to build his career and get his foot in the door with that bank to become not just a VP, but a senior VP down the road. They're all on career tracks. So the job satisfaction of helping somebody that was trying to improve their life with investments, and I'm able to give them some tools, give them some coaching, consult with them, and watch them grow over time. I've got one gentleman that started out with just 3 or 4 houses, and I helped him in the beginning, and now he just bought a $8 million property. So if the job satisfaction of being able to grow with somebody like that, I mean, I'm friends with the lenders I know and the clients I've got most of. Just because it's real personal when you're getting into somebody's personal financials to get them qualified for a bank.
And Leigh, if somebody were to come from, let's say, the single family arena, and then one day says, "Hey, Leigh, I'd like to get a head start before I decide to work with you or with anybody," what would your best recommendation be that they start to work on? Is it credit? Is it reserves? Is it debt? What would you consider to be probably one of the biggest things, knowing that they're new to the commercial investment world?
Well, for one, get a personal financial statement built, and that it's accurate, because it's on the asset side, the first line is cash. Well, keep in mind, or if you don't know, that a standard bank loan is going to be an 80-20 loan, right? 80% loan value is what they're going to give you. It's not negotiable. I've seen guys come in and think they can negotiate that, but they're not. 80, even 75% LTV. So on the cash line of your personal financial statement, you better be able to show that 20% as your down payment plus some, because they don't want to drain you to get a deal done. So you've got to be able to show it's called liquidity. You've got to be able to show the liquidity to close the loan and have some living money and service the debt, of course, on all those other things. So there's, on the personal financial statement, is an important component that a lot of people have never been asked to do one. So get your PFS in line. Understand that if you've got 10%, the bank's going to want 20%. And if you go in there thinking you're going to negotiate to 90% LTV, you're not, and you're going to come off looking inexperienced. Mm-hmm. So having your PFS and your liquidity in order is the first thing you should be concerned about if you're going to go into a commercial deal.
Okay. And what about the identification of a bank? Obviously, starting again, we're going to continue to use the base foundation of somebody in real estate investing from the single family to the commercial level. What type of banks and identification should they be going after? Like walking into a Chase, a Merrill Lynch, or do they go see Joe over at First Community Bank or something?
If we're talking about a low loan amount, $100, $150, $200, $300,000 deal, to where your average commercial banker, that's going to be a little bit off of his radar. Go to your bank where you've got a relationship already. So whoever you know at that bank that maybe did your primary residence mortgage, or they help you with your business checking and business banking. If you have a business, they can introduce you to somebody on the commercial real estate banking side if they can't handle it themselves. And then you've got an entree for what's a small deal that they're willing to do the work because they've already got a relationship with you. Then there's other lenders, called non-bank lenders, that they're not available to the guy on the street. They use people like me as sort of their outsourced sales department or representation. So there's pools of money that they'll build a commercial loan product around. And then those types of pools of money are looking for the investors, and they come through people like me to bring that business to them. And that's called I call them non-bank or matrix lenders, because they publish a matrix typically that I get, and I can kind of do a cross-reference to the property and the property type and the loan to value and so forth, and price a loan for somebody, and price a loan for an investor, and then help that investor package it up to get non-bank financing. And those non-bank loan companies have some advantages. They're going to be a little bit higher rates sometimes than they'll be higher rate than a bank, but then they'll have a 30-year amortization as opposed to a 20-year amortization. So let's back up again, Diego, for the basic information. A regular bank loan, your community bank loan, which is what most people that's the only familiarity they have is
Correct.
with the community bank, right?
Correct.
They only know there's other lending sources available possibly. So that community bank loan is going to be a 80-20, and it's going to be a 2, 3, or 5-year term on a loan with a 20-year amortization. So it's like I said, 2, 3, or 5 on a 20-year am. Well, there's 10-year terms on CMBS loans, which high-end loans for like buying a a 10-story office building, the CMBS loan market, you get 10-year fixed all day long, where a community bank's not going to offer you that. But if you're not in that market, or if that lender is not going to look at your type of property type, it doesn't matter. But to know how to shift somebody from one type of lender to another is what I can help them do. I bring them that flexibility. But back to the matrix lenders, if you can get instead of getting a 6% loan, you can get a 6.99 or a 7.5% loan, but they'll give you a 30-year amortization as opposed to a maximum 20-year amortization at the bank. Then once you do the math, you might find that your cash flow on that property is actually better because your mortgage payment is possibly lower than what you had at the bank. On that lower rate but shorter amortization, a slightly higher rate and a significantly longer amortization can increase your cash flow.
Mm-hmm.
And to small investors, that's significant. Cash flow is king,
Right. That's one thing. And now another big question that a lot of people are asking is, since we come from the single family residence or arena or in the new construction, there's a certain period of time that we have to lock properties down, which in the commercial realm, you guys call that your feasibility study time, right? Your periods.
Yeah.
What would you consider the average feasibility study allowed if somebody's looking to write a contract? The smaller the obviously the shorter the time, the more attractive you look, or is it the more do you come in hand already with the financing end of it, or a letter of intent, those types of things?
Now, I'm blessed enough to have been in the business long enough and developed just a referral base, and so most of my referrals come from commercial realtors, and then also I get them from bankers that had to turn something down and they don't want to just cut that client loose. They want to help them out. So with those commercial realtors, I train them. I say you never get less than 90 days on a contract, because it can take up to 90 days to close a loan. Sometimes it can go over. Sometimes we can close in 45, 60 days. But if you can strain yourself on the contract and to less than 90 days, and on average it's going to be closed somewhere close to that 90 days, you're going to hurt yourself on having to go pay a renewal fee, to extend the contract or something like that. So as long as everybody understands that the seller of the property, the seller's agent, your agent, and you as the investor, as long as everybody's on the same page that standard loan period is going to be 90 days, get that on the contract. Don't sell yourself short, because if you do get squashed on time, it's going to cost you money, or you're going to lose the deal.
Great.
Let's see. There's a couple of things I wanted to talk about just on the documentation. We talked about a PFS, personal financial statement. When you're documenting a loan, you as an investor have identified a property. You want to go buy a 10-unit apartment project. The lender is going to ask for the borrower documentation and the property documentation. So under the borrower column, personal financial statement, 3 years tax returns. They're going to they're going to underwrite on a history. A 3-year history is typical. And then the same on the property. They're going to want to see if you're buying an income producing property. Those 10 units have been there for a while. They've got the owner, the one you're buying it from, they've got historical financials. You can't always get historical financials, but in a perfect world, you can get a 3-year history of financials from that property, and that'll show that lender that you've got the income to cover that property, and it makes it a lot easier. So, and if you're dealing with an experienced operator that you're purchasing from, or an honest operator, a lot of times comes into question. But if they're experienced or honest, and they understand that those financials are going to help you, which is going to help them sell the property. So you can get those financials. And then you've got your, which is going to, and those financials, the typical financials are just, it's P&L and balance sheet. Cash flow statement, the three in accounting are P&L, balance sheet, and cash flow statement, right? Mm-hmm. But typically you're just going to get a P&L, which is also called an operating statement or an income and expense statement. They're all the same thing, but you get the P&Ls and the balance sheets for 3 years, and that will sustain the documentation for a loan. And it's the same thing as if you've had a property for 3 years and now you want to go get a rehab money on that loan, they're going to say, well, let's see your 3 years operating financials. So just like that, you're asking that seller to produce financials to you, that lender, if on a property you're owning and operating right now, and you need to go get some debt to put on it, they're going to ask you for those same financials. So there's nothing new there, but lots of new commercial investors feel like they're being violated by being asked for all these things. But it's just new to you. It's the same for everybody.
And you said something that's very interesting here is if you're working with a seller, at that point, the seller, it's in his best interest to help you state that case, because both of you guys are going to be presenting obviously to the VP, that goes eventually to the committee and the smaller bank. So both of you guys are on the same team, right? Yeah. Okay, yeah, great. It's a good way to put it there.
And that seller's realtor, and let's say everybody, both the investor and the seller are using realtors, neither one of those realtors get paid unless the loan closes, right? So you should have plenty of help there in getting those financials for you. I know one doctor that started out with single family investments, turned it into multifamily investments, turned it into where he is syndicating large projects now. He's been doing this for like 15, 20 years. And he's bringing other doctors in, and they're all pooling funds and going and getting loans for large projects, which have anchor stores in them now. So if you're passionate about commercial real estate, it gets in your blood. If you're the type of person that's in single family investment now, but you've got a passion for the business, you will just naturally, organically go into commercial. And but this doctor was where was it going? Well, I lost my train of thought there, Diego. I had a good story.
That's okay. It's a lot of information about the doctors creating the syndication and presenting that in order to go on to bigger projects.
Oh no, thank you very much. We were talking about a seller having prepared financials. He now, because he's in the business of buying properties, running the syndicate for a group of investors, improving that property. Sometimes they hold them, sometimes they flip them, right? They've improved it, now they're going to sell it. And when he goes to sell a property, he already has a financial package to hand off to any potential buyers. So he's doing everything. He's in the business of making a profit on that property, and to do that, he's going to facilitate the buyers being able to buy that property by giving him clean historical financials. Make sense?
Absolutely. So let's just say, to summarize here, because I'm starting to get questions, and we want to go ahead and make this very, very open to the public, is identification of a good opportunity doesn't mean that the bank is going to think it's a good opportunity, right? The other thing is the positioning of your financial situation in the eyes of the bank, and then having that bank be your eyes and ears as to what you're needing to present it to get funding. And last but not least, on the representation side, you do need to have a good commercial type real estate broker or agent that understands the relationship between you and the seller. But all of those two pieces can't come together without you, for example, not directly promoting or endorsing you, because I've seen your work. That's why I think it's funny is I can always tell you know exactly what you're talking about when you're behind the pen and the paper, but in front of a camera. This is Leigh, right? But you know your stuff. I can definitely tell you that. So we had a gentleman ask us earlier. Lamar asked, in your eyes right now, what are you seeing towards with the market with COVID? You know, what's happening to the banks? What's happening to the not going too much onto the, you know, convenience stores or hospitality or even, you know, things like that, but in the realm of single family, are you seeing a little more tightening up for people that want to buy a new construction type or start a new construction type fourplex, you know, those types of things?
I've not seen any tightening. There was a time where just people were not coming to the banks with the deals. Everything was just dead for a while. But then 3 weeks ago, the dams opened, the banks were back in business, and all of my community bankers that I talk to are saying that they are just swamped. They're covered up. So, and to answer your question with respect to COVID, they're busier than normal. It's what do they call it? The pent up demand. That demand that would have been there and smoothed out over months was just corralled, you know, dammed up and let go, and now everybody's super busy. Now there are on things that kind of out of our scope, Fannie Mae, Freddie Mac type large loans for the Camdens, you know, the Class A multifamily 300 unit 4-story places. Those types of lenders are going to be Fannie Mae, Freddie Mac typically, and Fannie Mae, Freddie Mac are tightening guidelines, and so there are long-term investment lender guidelines that will be affected by COVID. But as far as just the street level investor that's looking at dealing with the community bank right now, the banks, they're looking for business and they're busy right now too. Does that answer your question?
Absolutely, absolutely. A gentleman asked earlier if looking at a profit and loss for a fourplex, which may not exist as it's more individually as an asset, what other documentation would they be able to provide to move that into presenting it for financing?
Leases, market rents, because on a fourplex, you know, you can support what would be on financials if financials don't exist, just with market rents, and you can get over that hump pretty easily on a small property like that. So if just a rent roll that's in a good professional format, like I can supply somebody if they needed it, that's going to break down how long that lease has been in place, when it renews, what the current rent is. So you can just you can back it up with just history on a rent roll, and also if the current leases are below market rents right now, then you can boost the strength of that loan by saying that when I renew, I'm going to renew at market rents. So simple things you can do in a case like that in a fourplex to get around the fact that a seller might not have good, clean historical financials.
Excellent. And Zach, I hope that answered your question there, sir, which you have that. Let's see here. Wouldn't a single family fourplex, let's see here. Zach just sent this in here. Wouldn't a single family fourplex unit fall under a residential type mortgage versus a commercial? And the answer would be?
Yes, but no.
Yes, exactly.
Right, because Zach's absolutely right that multifamily is 5 units and above. So 1 to 4 units, but you're still talking about an investment property. Single family investment is not commercial, but it's not primary residence either, right? So commercial bankers will, you know, they might not want to look at a $100,000 investment property, but if you've got 10 $100,000 investment properties, or you've got three $400,000 single family investment properties, now suddenly, they're willing to look at those numbers. But yes, by definition, a fourplex is not multifamily.
Okay, great. Let's see here. And I guess this kind of shines a light in what you were saying also. Just because it may be the fact that a residential or a conventional lender may below 4 units or below, may say that this may not be the time to have properties that are cash flowing. On the flip side, a banker might look at it in a different perspective, right? And then vice versa.
I missed what you meant there by not cash flowing.
Well, basically, every scenario is different, right? You have to look at every scenario is different, because somebody asked a question that some may naturally will get into the commercial side. However, right now it seems very risky with an oversupply of office space, low margins, and multifamily. Is it really any better than residential to buy and hold, or new construction, 10 plus homes? So I went ahead and replied to that one is, every investor is different, every scenario is different, every deal is different, right? Yeah, and
the risk, they're right that there's going to be different risk scenarios, but it really comes down to the individual investor. If that individual investor doesn't want to stay in 10 single family investments, that they want to get into retail or office or something like another commercial, self-storage, something like that. If that's where their mind and personality is going, there's not too much risk there. There just is going to be different risk. And that's where you have to educate yourself.
Absolutely, because there's risk in everything, right? Lamar asked this question here, Leigh. Today's tight market, people are coming up with new ideas to rent each room to separate individuals, have 3+ homes. He has 3+ homes, is considering a multifamily loan. How would that look on paper to him? That it's not one lease, but it's 3 people. If you were presenting this deal to, let's say, to get
it happens every day.
Okay.
That's not an uncommon scenario. You've got 3 properties and you want to refinance them to a better rate or into one loan. Have to put into another property. So you're cross-collateralizing your existing properties, taking that equity to get you a new property. A bank will look at that as long as they're holding all those properties, their loan base is growing, right? Because you're about to buy another property. So those things get done all day long.
Okay. In regards to the process, can you give us a little bit of timelines in like your average bank for receiving documentation to the next step is obviously, I'm assuming, have an appraisal order, or should that appraisal already be in play, vice versa, those types of things?
Yes. The standard process is first we're going to document it, the property and the individual, to give them enough to do a loan analysis. And then on that after that loan analysis is done on the inside for them, they're going to come back with what's called a conditional approval. Most times they're going to call it a conditional approval. Somebody else might say it's a letter of intent, but they're intending to close that loan, and they're going to issue some terms. So if you agree to the terms that they offer on that conditional letter of approval, you sign that, and they'll order third parties, which is going to be environmental and appraisal. And you might have to come out of pocket for the third parties yourself. So they might, at that point, you sign the letter, and you might need to give them $3,500, $4,500. They order the appraisal. And so basically everything stops, and you have the third party process is going to be typically 30 days. 3 weeks to a month is right, Diego? Mm-hmm. So 3 weeks to a month on the third parties, and then they'll pick it back up. And as long as nothing is everything's okay with the third-party reports, they move forward into closing. Then they start issuing the docs to the title company, and we go to closing.
And obviously, Lee, those costs and timelines are gonna differ from 5 units in a 1 unit building to they're doing an appraisal on a convenience store, right? They're completely separate. But on a multifamily, anywhere, let's say between 5 to 15 units, what do you notice the cost of an appraisal and timeline would be for something like that?
Cost could be $1,500 to $3,500, and time frame is, I used to say a month, but it's pretty much 3 weeks that I've seen recently.
Mm-hmm.
And then you can pay a premium because they might say, okay, we can do it in 3 weeks, but if you want to pay extra, we'll do it in 2 weeks. So
Customer service.
right. So appraisers will have a price, and then they'll have a rush price.
Mm-hmm. Now, can you explain to us just a little bit here in regards to when working with the commercial side, and again, heading back towards the multifamily, when you get to larger amount of units, let's say between 5 to 20, 5 to 10 or 5 to 15 units, that asset has a certain appraised value, but it also has a performance value. Am I correct to state that? And that's how people see it, depend on how it's occupied, or?
No, in the appraisal, there's 3 approaches, they call it.
Mm-hmm.
The income approach is the approach. On an income producing property, it's the income approach that's done. So then there's, I even forget what the other 2 approaches are. That's really comes under appraisal or valuations expertise. But so to answer your question is yes, what you're talking about was the word you used is not the standard name for one of the other appraisal approaches, the lesser used approaches, but it's the income approach that counts, and that's NOI, right?
Right. There's a cost and the comp. There's a cost and the comp value.
Right.
Mm-hmm. Thanks, Zach. All right. So here, do you want to shine a little light on us in regards to where you're seeing might be in the world of commercial, what's out there in the grapevine from bankers? Are they becoming a little bit more open to lower rates? You know, what is prime right now? What is prime? And explain prime, I guess, to the level.
We can find out real quick. I don't. Wall Street. It's Wall Street Journal Prime, WSJ, but Wall Street Journal Prime. So you'll hear Prime Plus. I don't really follow the prime rate every day, but when a bank issues that conditional letter of approval, they'll take whatever prime is at that particular time, and typically they're going to do a Prime Plus 1, Prime Plus 1.5, Prime Plus 2. So that's where you go. You can look in the newspaper, and they'll put it on the letter itself. They'll tell you what it is, so you can see that what your total rate is going to be. But if they put it in terms of Prime Plus, what they mean is it's that day's Wall Street Journal Prime plus whatever premium they're going to put on that.
Okay. Normally, when a person is looking to work with a bank, what would you consider to be a good something good to identify with that bank, how they conduct business? Is it that that they charge points, fees, that they have a certain, what makes a good relationship of working with a bank? Because I know a lot of people, and I know for myself from working with a lot of our members, they'll tell me, hey, I just went and visited a gentleman at Allegiance Bank, and I asked them, well, did you ask if they're even in the appetite of are they lending to this? And they're like, no, I didn't ask. What would you say is something that a good bank will first tell you, hey, this is how we work?
It really comes down to the individuals or people and relationships, not even the separate institutions. Just to back up real quick, Wall Street WSJ Prime is 3.25 today. And this is sort of something that I was enlightened to. One day I said, wow, that's not what I would have expected, was that in developing my banker relationships, that bankers move, they'll go from Prosperity to Green Bank to Allegiance to Moody. Over their career, bankers move. And inside one bank, you can have one banker that doesn't want your project and another one that does. And there can be various reasons. They've got a certain expertise with, they prefer to do industrial or light industrial, right? They're looking for the flex space, mini and small and light warehouse type stuff. That's the business they're looking for. And you bring an apartment project along, and they just like the investor has certain interests, the bankers have certain interests that have turned into areas of expertise. It doesn't mean that they won't take it, but what I have developed over time was relationships with individual bankers that I know can take care of a certain type of project because we have a personal history of doing those types of things. And if that banker is one day at Allegiance and the next day he's at Moody, I'm gonna use him as long as there's not something inside the bank's guidelines that prohibit you taking them that piece of business. But apples to apples, I'm gonna go to my banker relationships, not my bank institution relationships.
Right. Absolutely, yes. And each bank sees that in a different way. If there is differences within the actual organization, there's obviously differences in how they're quoting rates and how they're quoting terms. We had a gentleman here, Zach, said he had a couple questions for us. Zach, you've been asking some good questions there. Go ahead and if you want to type your first one in. Let's see here. Well, before we do, while Zach's typing that in, I'm going to run a poll here real quick, if you don't mind. I'm launching it. And we'll see what people may want to answer here. Give it about a minute. Feel free to answer that real quick. All right, well, this is going on here, Leigh. With the polling here, Zach asked a question. He said, what about small new construction, fourplex units? What particular type, would you be able to assist with somebody in putting that together for construction and land acquisition? And obviously, how does the draw process work? Is there a difference as a draw from a traditional lender or a hard money lender, what we're used to?
Probably. I'm not that familiar with the hard money, like jet lending draw processes, ISBs, but I believe that they're different from a bank draw process. Typically, a bank draw process is going to take your loan, 80-20 loan. They're going to fund that. First, you have to give, on the land purchase, you'll have to give them a good sales contract, purchase agreement, and a good budget. A good solid, the investor has to bring a good solid construction budget, and you'll probably have to do 3 years projections on the business if you're going to operate that, as opposed to flip it on completion. So with you getting your stuff squared away, you get approved. Now you're in the draw process. A lot of times that lender is going to take your down payment and they'll use that to pay the draw process, pay the contractors, subcontractors. And then once they've worked through your money, then they'll start putting in their money. Make sense?
Mm-hmm.
It won't feel any different to you because you've already put that money up. But that's the way they look at it, is they're using your money first and then they'll go into theirs in the draw process to complete it.
Okay. Zach, I hope that answered your question there, sir. And if
which I think is different from hard money draw process.
Absolutely. And Zach, if you want to go ahead and email me, we are in the process of working on a couple duplexes, and we're going through that process. I'd be more than happy to talk with you about that. So let's show the results here. We had 44% general commercial knowledge, which is great. You know, obviously that's the target audience that we wanted to have, Leigh, and really appreciate you spending the time on that. And you can't learn the language of commercial in 2 days, right? or even in an hour here. So there's a lot of people that are joining that have that knowledge, and we really appreciate the feedback and answers. Lender types and loan types was the most at 50%, because it is a different world. You know, it is a different world. I believe from when we were handling some large construction projects, and we started dealing with just the handling of the draws, we had to deal with an AIA contract, you know, and AIA, it's the American Institute of Architects, which means that your engineer and your architects that handled the whole process of presentation of docs and plans, they're kind of the go-to person with the bank. You know, and that's huge. It's not your contractor asking you for draws. It's now we got to check this guy's spot checking everything to make sure.
Construction management company.
Absolutely. And
construction management company is using, like you said, an AIA format, and you've got to submit your budget to them to get your budget approved in that AIA format. That goes back to what I was saying about don't think you're just going to be able to throw in a rent roll in an Excel spreadsheet. You need to have a good format.
Absolutely.
That has things broken out for you.
Right. And, you know, Leigh, that's the whole point of why we do what we do, is because people do want to embark in the commercial. People do want to go into multifamily. People do want to go into new construction. And it's better to have people like yourself that are open to answer those questions, because other people do, obviously, that they know it all. But it's better that the ones that need that opportunity to be able to have these questions answered. Let's see, Zach asked one more question before we move on and close this out. Do you have any lenders that are open to working with mobile home parks?
Yes.
Right, there you go. So
mobile home parks and RV parks are strong. I've got one investor I'm working on my fourth RV park with, $4.5 million new construction. You can see it on Katy Freeway out there, Brookshire, when you're on the way to San Antonio.
Oh, whoa, okay. So with that there, guys, I really want to thank Leigh, if you want to have any final comments. So
I do, Diego, because looking at this 50% of interest in the lender types and loan types, I'll give you a quick story about Joseph. This gentleman, Joseph, was looking to buy an 8-unit apartment project over in South Houston. It was 100% occupied, newly renovated. It was just pristine on a financial and on a physical standpoint. And he had gone to 6 different lenders in 7 months and gotten 6 declines. Somebody referred him to me, and my question was, why are you getting declined? And he didn't even know. So I happened to know one of the lenders that had declined him and called him and asked what the situation was. Turns out he was trying to buy the property from his half brother. And because he was related, there's something called a non-arm's length transaction as opposed to an arm's length transaction. So they considered him buying from a family member a non-arm's length transaction, and he was getting consistent turndowns because of that. It had nothing to do with the viability of the property. So once I understood that, I just went to a hard money lender, got him closed in less than 2 weeks. Now he has property in his name, and I took him back to a community bank and had him refinanced into a. So then with the bank, it's not a purchase, it's a refinance, because he's already got a title in his name through the hard money lender, and so now there's no non-arm's length or arm's length transaction involved. It's just a refinance. Yeah. And so I solved that problem for him. And then down the road, the same gentleman has multiple retail properties over in South Houston, East Houston, and I was able to take him into what are non-recourse, a CMBS loan. We bundled several of his properties into a 10-year fixed, 30-year amortization, non-recourse loan. So I offer people the flexibility and can consult them or coach them on how to go through those transitions.
Excellent. And that's exactly what I was about to say to close this out is your contact information they can find you on the web. They also can go ahead and we've been sending your contact information via chat. You're such an open person that people can call you up. I do remember in the past life when in the mortgage industry, you and I would sit there and enjoy a nice scotch and a cigar, just talking finance.
Yeah.
Can't do that anymore, you know. But absolutely, I really appreciate, Leigh, all your information. And I know you're such an open person that people are going to call you and you are going to be more than just here's the information. It's like, let's build a relationship. So
yeah, Diego, I just want to say real quickly in closing is that job satisfaction for me is helping people. So it doesn't matter what business I'm in. It's probably the same for everybody, is that your real job satisfaction is those relationships and connections you do. And when you know at the end of the day that you've helped somebody
yes,
achieve their goals. And a lot of times, especially with the small investors, their personal goals and their business goals are the same because it's, you know, real important, small amount of dollars they've got, and it's directly tied to their family. And so I really like helping people through that phase into a stronger phase of their investment careers.
excellent.
That's fun for me.
No, excellent. You're a great guy. So everybody that joined us, Enid is putting out the email if you guys want a copy of this webinar that we had. And also, guys, make sure to subscribe to StratiVentures on YouTube. Enid and Oriana always ask me to ask you guys to do that. We look forward to seeing you guys next week. If you subscribe, I think the girls are putting this up on the SVI YouTube channel, so you can see it there also. Just remember, guys, that StratiVentures is a company that's built by investors for investors. And so those of you that are new to real estate investing, feel free to give us a call. We are by far probably the company that I believe has been the backbone for a lot of new investors to succeed. And I believe we just hit over 800 investors in our group. We're constantly growing. So really would like to thank you again, Leigh, and everybody that joined us. You know, have fun, stay safe, and we'll see you next time.
Thanks, Diego.
Yes, sir. Good evening.